Hello and welcome to Livewire Markets. My name is Chris Conway. Today I'm sitting down with Laurence Parisi. Laurence is the head of direct property at Trilogy Funds. He's going to be talking to us about what's going on in the property market right now and an exciting new opportunity for investors. Laurence, it's great to see you again.
Likewise, Chris. Good to be here.
Laurence, let's start at a high level. What are some of the major themes investors who are focusing on property need to be aware of right now?
I think the biggest one from our perspective is interest rates and monetary policy. On the back of the CPI now back within the target band, a falling interest rates, which ultimately mean a reduction in interest cost is probably the biggest theme that we're seeing and enthused about. Transactional volumes are also increasing on the back of the few rate cuts that we've had, and that will ultimately flow into price discovery in commercial real estate, which hasn't really been there for the last 3 years. I think the tailwinds that industrial and convenience retail are benefiting are going to continue over the short to medium term. Office still remains challenging. And then finally, from our perspective, just construction costs. They still remain elevated, which will ultimately mean the amount of new supply coming online over the next 2 to 3 years will be benign.
Yeah. What about the next 12 to 24 months, Laurence? Not asking you to crystal ball anything, but you talked about lower interest rates. There's some expectation that the rates will come down even further. What does that look like for you guys over the next 2 years?
Yeah, we believe we're in the early stages of a moderate recovery. What that ultimately looks like will be dictated by geopolitical issues. GDP, domestic economy isn't firing in all cylinders at the moment, but with further scope for interest rate cuts leading to interest cost reduction, I think that will lead to transaction volumes increasing, investor sentiment, investor inquiries will start to increase, and overall we're relatively optimistic on the outlook. However, some degree of caution is required over the medium term.
Yep. Laurence, just a question without notice. You've been doing this for a while. You've seen a lot of these cycles, and you talked about the beginnings of a recovery. How do we know when we're in a full-blown recovery and things are really ramping up? Is it sort of only once you look back?
It's usually too late.
Yeah, well,
it's already happened.
Yeah, right.
However, so early signs are transactional volumes, right, and investor inquiry, investor interest in real estate, and we're certainly starting to see that.
All right, Laurence, we're here to talk about a specific opportunity. It's a convenience retail opportunity called Brighton Village, located in Butler, which is a suburb in Western Australia. What are some of the features of the property, Laurence?
As you mentioned, it is in Butler, which is a suburb in Perth, about 41 kilometres north of the Perth CBD. It's a strong performing Coles neighbourhood shopping centre. Located on about 12,000 square metres of land. The centre itself is approximately 3,800 square metres, and it's complemented by 6 specialty retail tenants. It has high exposure and is located in Butler, which is an established but growing demographic in Perth.
Yeah, talk to me a little bit more about that. So in Wanneroo, if I'm saying that correctly, growing catchment area, expected to add 70,000 new households in the next 20 years.
That's right.
Is that above system growth or above
average
growth?
Absolutely. Population growth is the key driver of that, and also affordability.
Yeah, for sure. It's a retail-focused property now, Laurence. Some investors think that bricks and mortar retail is dead. Clearly it's not. It's not the case. So tell us why, and perhaps share what makes this particular property stand out.
Yeah, sure. So bricks and mortar retail is definitely not dead. Depending on the type of retail that you've been in over the last 10 years, it has been challenging as consumers, retailers and landlords figured out new world order, so to speak. However, I think what we're realising now is that the two work in unison. Specifically in convenience retail, we're of the firm belief that online growth in sales is not a contributing factor at all. I mean, the very nature of the convenience retail, essential services, the daily needs in and out of the local shopping centre 2 or 3 times a week just dictates to us that you're not going to be dramatically impacted by growth in online sales. However, in saying that, the supermarkets do offer online, and the centres that we both currently manage and have analysed, online sales typically account for 5 to 10%. And that can actually be beneficial to the landlord itself, because depending on the lease structure, the landlord benefits by turnover rent that the supermarkets ultimately report. So from our perspective, convenience retail is here to say. Online growth in sales shouldn't impact it, and we're pretty enthused about getting exposure to this sector.
Yep. You and I joked about it talking earlier in the week. You do your shop on a Sunday, and then by Thursday you're back there getting a fresh meal because the kids don't want to eat what you've got served up for them. So, no, definitely the foot traffic is important. This property, though, what makes this one stand out? Because again, I imagine there's lots of opportunities that come across your desk, and you've got to select from a suite, shall we say. So what was most important about this one, and what does the process of selecting look like?
It's a well-worn process. We filter and see a lot of opportunities. They typically come through your traditional networks like brokers and estate agents. This particular asset was no different. It was introduced to us by an agent. So we initially undertake a good amount of due diligence, desktop, and then further advance that due diligence, appointing consultants, lawyers, valuers, technical due diligence, environmental consultants. We typically also engage with tenants as part of this process. And what that ultimately culminates in is a rather detailed report for our investment committee, which we present, debate, and ultimately decide whether we're going to progress this opportunity or abort. This was no different. What we really like about this particular asset in Butler is the catchment that it sits in, the very, very strong performing Coles. Coles dominate the income of the centre. 78% of the income of the centre is underpinned by Coles, complemented with 6 convenience retail specialty tenants. We feel that we've been able to buy it on attractive terms. So $25.3 million is the contracted purchase price, which implies a 7% cap rate or yield. And for a centre that's underpinned by Coles with a 7.5-year WALE, 100% occupancy, we feel that investors will ultimately be rewarded by getting exposure to this asset.
Yep. Laurence, just one thread I want to pull on there, the yield at 7%. It's my understanding, maybe a very basic understanding, that that's pretty good in the current environment for this type of assets. Maybe some others are sort of high 5s, low 6s.
Yeah, we believe so. These centres typically trade firmer than that. Yep. So we feel that we've bought well, and that's testament to our process, our network, and our, I suppose, ability to execute on a transaction when we see something that we like, and that should ultimately culminate in strong returns for investors.
Yep. One other quick one, just for my own interest. How long does that process that you were talking about take? Is it sort of 3 months, 6 months? I suppose it varies, but
it does vary. But from start to end, it's usually 3 to 4 months.
Yep.
So we're well advanced at the moment. But this process started 60, 70 days ago.
Yep. Yeah, no doubt a lot of work goes into it. Hypothetically speaking, what are some of the ways that Trilogy might look to improve the asset?
Typically, with some of the other centres that we own, we'll look at advertising of both in the centre and pylon signs out the front. You can look at solar initiatives if appropriate. Cellular towers are pretty popular these days, and more recently recycling initiatives, particularly in Victorian assets. We'll look at all of those attributes and see if we can drive income.
We've talked about some of the financials already, but let's just go over them. So the WALE?
7.5 years.
Yep. Occupancy?
100%.
There you go. They're pretty good numbers.
Good numbers to start with.
Absolutely. What else? Is there anything else we need to cover off on there?
Yeah, look, we're buying it at $25.3 million, which implies 7% cap rate or yield. Once we put that into a capital structure in an unlisted property fund, we're confident of being able to deliver 7% through the forecast period, which is the next 2 financial years.
Yeah. So aside from the 7% yield, what's in it for investors?
I think ultimately a good degree of reliable, consistent income with the ability for capital growth over the medium term.
Yep. And last one, and perhaps most importantly, how do investors access the opportunity, Laurence?
Great, that's important. So trilogyfunds.com.au. You can also get in touch with our investor services line, or ultimately speak to your financial advisor.
Fantastic. Laurence, thanks so much for sitting down with Livewire and taking us through the opportunity.
Thank you, Chris. Appreciate it.
If you enjoy that interview, make sure to give it a like, and don't forget to follow our YouTube channel because we're adding lots of great content every single week.